The S&P 500 just performed a maneuver it has only attempted 4 times since World War II. It gained 16% in just 2 months. Looking back, 3 instances happened as the economy emerged from recession. The economy tanks, stocks follow, then snap back. But the 4th time was in 1987, right before the Black Monday crash, where the stock market lost 20% in a single day. Today, the United States is not coming out of a recession. That makes the 1987 anomaly the only historical parallel that actually fits our current situation. This raises a difficult question about the current rally. If there is no post-recession recovery to drive these prices, what exactly are investors buying into? The current confidence is built on the massive scale of investment in artificial intelligence. This year alone, between $2 and $3 trillion are being funneled into AI infrastructure as companies race to secure a piece of the technology. History shows us that being right about a technology doesn't protect you from a market collapse. Railroads, electricity, and the internet all lived up to their promise of changing the world, but the stocks tied to them still saw catastrophic boom and bust cycles. To see if history is repeating, we check the Shiller P/E ratio, which compares stock prices to 10 years of inflation-adjusted earnings. We are now just percentage points away from the most expensive valuation ever recorded, surpassing both the 2008 crisis and the dot-com bubble. During the dot-com bubble peak, investors paid $44 for every single dollar of earnings the market produced. Today, we are rapidly closing that gap. This suggests the market is pricing in a perfect future, where nothing goes wrong, fueled by a fear of being left behind, while ignoring the financial data of the present. While the stock market looks at future innovation, the bond market operates on a different set of rules. It prices based on risk. Right now, bond investors are looking at the economy and reaching a very different conclusion about our direction. If the stock market's vision of AI-driven growth and deflation were accurate, we would see interest rates falling and yields dropping to reflect easier borrowing. Instead, the opposite is happening. 30-year U.S. Treasury yields have crossed 5%, reaching the highest level since 2007. Borrowing is becoming more expensive, not less. This trend is driven by the reality of the U.S. national debt, which is now closing in on $40 trillion. Because the debt is so high, the government must issue more treasuries just to function. Since rates have risen, these new treasuries carry much higher interest payments. This creates an accelerating cycle where the cost to service the debt causes it to grow even faster. The bond market is signaling a mathematical impasse. There is a limit to how much debt the system can carry when the cost of that debt is rising this rapidly. Beyond the financial markets, we have to look at the physical foundation of the economy, the American consumer. Data on personal savings shows a significant decline. American savings have dropped to 2.6%, the lowest level since the 2008 financial crisis. This collapse correlates with consumer sentiment reaching its lowest level since tracking began in 1952. While Wall Street remains focused on the long-term potential of AI, the consumers required to drive the economy today are under extreme financial pressure. We have 2 markets betting on 2 different outcomes. The stock market believes growth will solve our problems, while the bond market suggests the debt will crush the system first. The deficit is a math problem that technology cannot easily bypass. Corporate innovation from companies like NVIDIA does not resolve the sovereign debt burden of the U.S. Treasury. We study these patterns through the lens of currency life cycles, the historical process where a currency loses its utility as a store of value due to excessive debt. When the cost of servicing that debt at current rates exceeds the government's ability to pay, the system reaches a breaking point. Historically, this leads to the rapid expansion of the money supply, triggering runaway inflation and ultimately requiring a total reset of the currency. Following the herd into an overvalued market is dangerous. As we saw with railroads and the early internet, you can be right about the future of the technology and still lose everything because the systemic risks were ignored. The signals in the data are clear. It is becoming a necessity to protect your wealth outside of the traditional financial system. Preparing for a currency reset with physical assets like gold and silver is the only way to ensure you aren't left behind when the math finally catches up to the market.